Hi, it's Woody here, editor of The Insider, and I'm joined today by Nick Hubble, old friend of mine. How you doing, Nick?
Yeah, good. Thanks. Good to see you.
And you, mate. So you're in Japan right now?
That's right. Yeah, I'm staying with the in-laws, and I'm pretty much stuck here because I can't go back to the UK. Not that I'd want to, and I can't get into Australia without suffering the quarantine, however difficult it is. So I'm here for the foreseeable future.
Yeah, right. So we were just having a brief chat just before I hit record, and we were talking about how property in Japan is like a depreciating asset. I just found that crazy, and it's so different to.
It's really hard to get your head around this one. So I don't particularly know why this is the case, but Japanese people consider houses to be a bit like a car that you buy and it depreciates over time. At some point, it has to be replaced about every 30 years, I think is the case. And I assume it's something to do with earthquakes or structural integrity and that sort of thing. But this is completely different to what property investing is all about in Australia and the UK as well. It's a world apart. And it also means that the houses are not built to last in the same way. So there's very little insulation. There's no double glazing or things like that. Obviously, there's exceptions, but this is the norm. And so, they're a bit less comfortable, to be honest. So I'm extremely cold at the moment because there's some snow outside and there's not much insulation and there's single glazed windows and the heating consists of 2 air conditioners for the whole house.
Yeah, well, you could have kept your jacket on. I wouldn't have minded, but I do appreciate you looking smart for the chat. But talking about structural integrity, let's broaden the scope from Japanese property to the global markets. So you've been pretty busy lately, and I know you do a lot of work in the UK, and obviously you're the managing editor of Strategic Intelligence Australia with Jim Rickards. Now, Jim's just published, well, it's not published in Australia yet. I think it is actually the first book connecting the pandemic with the economy and the consequences of that, not just from a biological standpoint, but also from how central banks, governments are globally dealing with it. How to start with, the other thing that's really good is that you've written a really in-depth. It's almost like, I think it's almost 20% of the size of the book itself. It's a bonus chapter which puts the ideas in the book into an Australian context. Where did you start? Where did you start with something like that?
Yeah, a lot of Jim's work and a lot of my work is sort of attacking the same ideas from lots of different angles. So when we decided to write this bonus chapter, once Jim told us that the book was coming, we thought, well, how are we going to go about it? And what writing every week and every day allows you to do is explore lots of different ideas in advance. And then you sort of pick and choose what the best angles were that you thought really worked. So it's slowly built up over time. And what the bonus chapter does is it brings together all the best ideas that we've had about the pandemic and about the fallout, the ideas that are sort of tried and tested that we've been able to connect to investment themes, and it brings them all together into one place. So that when you've read the book and you've read the bonus chapter, it's like a compendium of all the important things and all the important insights and conclusions that we reached over the whole course of the entire the last, I suppose, 12 months now.
Well, let's start with the big conclusion that you kind of reach, and that's one thing that you say is that Australia, I mean, we've had some of the most extreme lockdowns and everything, and for all intents and purposes, the virus has kind of been suppressed down here, unlike other parts of the world. But what you're saying essentially, or is what you lead with, is that we haven't really even had a pandemic yet. Can you explain what you mean by that?
Yeah, it's designed to be even more controversial than at the point that I'm actually trying to make is. So obviously Australia hasn't had a national outbreak that's comparable to, say, the UK or Europe or America or whatever it is. It was very much contained to Melbourne and to very small outbreaks in other places. That's fairly well established and understood. So I summarize that to say we haven't really had the pandemic in Australia yet. We have, however, had the consequences of the pandemic in the sense of lockdowns and the economic fallout and the economic crisis that comes as a result of the global pandemic. I'm worried this puts Australia in a very dangerous place because we could still have the pandemic and we could still have an outbreak. But even if we don't, we're stuck with the economic fallout. And the fact that we could still have the pandemic in the future means that we might be stuck with the economic fallout longer than other places that have already been through the pandemic, that have had it. Now, you could argue that it's not over yet. The pandemic is still ongoing. Completely agree. That's definitely possible, even likely, as the news suggests at the moment. But the point being that Australia, because we haven't had the pandemic yet, is going to be one of the last countries to emerge out of it. And that also means that we're going to be one of the last countries to emerge out of the economic consequences. I think that is the opposite to the narrative that's being put out in the media, that the countries that have protected themselves from the pandemic are going to be the ones that are going to be best off. I think I would suggest the opposite.
So you mentioned countries like there were certain countries that were held up as great examples of suppressing, and they've kind of switched now, like it's ravaged Sweden, for example. You also mentioned Ireland in previous chats, right? Are you worried that Australia could go the same way? Is that what it?
Yeah, it seems to me that the pandemic's designed to embarrass anyone with an opinion about it, because every conclusion we've reached as the pandemic has progressed has been disproven at some point. So the example in the bonus chat that I use is a study that was done in early 2020 about how some countries had these really big outbreaks and some countries hadn't. And if you look at the list of the countries that are struck down quite badly and the list of the countries that were not struck down, which includes Australia and New Zealand, for example, the other countries that were included in that group of countries that were doing well was Czechia, Bulgaria, and a few other Eastern European countries. Well, most of that good group actually ended up having huge outbreaks, like the highest in Europe or the highest in the world or the highest death rates of, for a period after that study was finished. So the point being that when you don't have the virus, it means you're more likely to get it next. And the pandemic just moves in that way for whatever reason. So I think in the book, Jim Rickards makes the same arguments within the US, where it made me laugh at the time a lot, actually. New York had the big outbreak initially in the US. And I remember one of the governors, I think it was Florida, was pointing out that he'd done the opposite to what New York had done in terms of policies, and therefore the virus wasn't a big problem in Florida. And then within weeks of him congratulating himself, Florida had the biggest outbreak and the worst consequences and so on and so forth. So there seems to be this trend that I've picked up on, that the virus ends up going to the places next where people are congratulating themselves for having avoided it or having mitigated it or dealt with it well. And Australia and New Zealand are one of the very few, or a few of the very few countries left that really haven't had this big outbreak yet. And that suggests to me that if this trend continues, at some point, there's a good chance there will be a big outbreak. That doesn't necessarily mean there has to be. We could still be stuck with economic consequences, just worrying about an outbreak. But my fear is that, at some point, Australia will be struck with exactly what countries like Ireland and the Czech Republic or Czechia, Slovakia, and the rest of Eastern Europe were struck with. And I mean, the political consequences will be awkward enough. And obviously, it's a bit of a nightmare health-wise. I've got family in Australia that I'll be worried about. But you need to worry about the economic and financial consequences of that as well.
Do you think, so obviously borders are shut right now. Do you think that matters so much nowadays as it maybe would have done 30 years ago? I mean, businesses are still, operating. They're still trading with each other. Do you think that I know one of the ideas, maybe we'll touch on this later, is that you see an opportunity in the travel sector and the airlines and stuff like that. But do you think that's going to be a bigger deal than what people think it might be?
I suspect it will, but I think it'll take a while for that impact to become obvious. I think it'll slow down things like investment, foreign direct investment between countries. Due diligence is a huge part of what fund managers and companies that have huge investments, what they do. And if they can't conduct that properly because they can't get their people in and out of a country, then I think it will have an impact. But we don't know. It's at least it's a huge uncertain question of whether impacting travel in the way that we have globally is going to be a big problem. I remember when the UK first started having its virus, it didn't close the airports at all. There was effectively no barrier at the UK's airports. And the reasoning was that travel was incredibly important to the UK economy, all of that dynamism, all of that. I mean, just the legal issues of not being able to travel. So I suspect what will happen over time as a result of, as particularly Australia's international travel laws, is a decline in productivity, which basically just means that we get less good at producing things. And there's two ways to grow your economy. One's immigration, which is also heavily impacted by these border controls. And the other is improving your productivity. So I suppose the conclusion would be that you'd expect Australian GDP to grow less fast relative to what it would have, and slower relative to the other countries that will be able to open their borders once they've had the pandemic, whatever that means.
Obviously, this week's a big week in the US, and Jim, a lot of Jim's work in the book is US centric and US focused. That's where he's based. Do you think Biden coming in is going to change things in any way?
It'll make the news a lot less interesting, that's for sure.
Yeah.
I think Jim's insights on this are by far the best in the world, actually, because he points out some things that I don't see anywhere else, such as the likelihood of Biden actually being in power, by which I mean he's got Kamala Harris as the vice president. He's got a team that's almost identical to the Obama team that's been put in place around him. Obviously, he's not physically capable of being the same sort of presence that Trump might be. So I suspect that it's going to be a question of the people around Biden. And what really brings that to the fore is when Biden was first winning the election, the question was going to be, who would he put around himself? Would it be some of the more left-wing progressives, the Bernie brothers, as Jim Rickards calls them, Elizabeth Warren, those sorts of people? Or would he go for the Obama-style cabinet? And he very much has gone with the Obama. In fact, it's an incredibly similar list of people. It's just in slightly different places, and some of them got promotions. So I think what we've got is a return to the Obama years. The exception to that at the moment seems to be that Biden is willing to take on China. And that's been a central theme of Rickards Strategic Intelligence Australia for years now, because Australia is in this unique position where we've got our economy tied to China and our national security tied to the US. So if the two start having issues with each other, then Australia is in a tough position. The way we talk about that in the bonus chapter is by saying that effectively Australia has to choose between its national security and its economy. And it seems that at the end of last year, Australia actually made a choice to favor its national security over its economy. And we've seen the consequences of that with the trade wars and the trade policies that China's enacted since. And that's going to cause some trouble as well, possibly ongoing if Biden does continue to take a hard stance on China, as he seems to be suggesting.
Yeah, I think there's one anecdotal thing. The Chinese are now paying how much? $50 for a bottle of yellowtail wine. Yeah. So yeah, one of the subheads that struck out to me, you said the central planners are back, and I think that's probably going to be more the case with Biden than ever now, right? But my question to you is, did they ever leave? It feels like with the whole global economy has been attempted to be centrally planned for years now. Yeah,
the difference is now that the number of policy levers that they're and the buttons that they're pushing on has expanded massively as a result of the lockdowns. And I think the real point is that they don't stop, they don't unwind, or very rarely do they unwind policy levers once they've started using them. So what we've had as a result of coronavirus and the lockdown is that everything, literally what we can buy, where we can go, when we can go, who we can see, everything we do is subject to government approval. And those policies have changed from week to week or month to month. Because I cover a lot of different news in a lot of different countries, I really noticed this because the restrictions are different in each place. And I saw this play out in London when I was living there, and how ridiculous it got. But the point being that when governments go to this point of having that much control over our lives, they tend to not roll it back, at least not completely. So
what's that saying? There's nothing more permanent than a temporary government policy or measure
program. That's right. Yeah. So that in essence is what I'm trying to say. But my worry is that the consequences of that are going to be a problem, because when you've got governments interfering in people's lives to the extent that they are now and will continue to do in to some extent, it goes back to the argument before about productivity and GDP growth, where the government can't really distinguish between what GDP is worth doing and what GDP is not worth doing. That's not a distinction that economists make either, but it's an important one, because if you spend your GDP doing something that is not worthwhile, that doesn't make sense, then at some point there's going to be a reckoning. At some point there's going to be a consequence to that. And usually the response to the threat of a reckoning is to do more government policy, which is one of the reasons why this is not going to be a temporary government program. It's going to be a permanent one. So the obvious examples of all this are the bailouts, suspending bankruptcies, suspending evictions, all of the government policies that we've seen rolled out as a result of coronavirus. They might morph into something else. So for example, at the moment, there's the issue of basically we've instituted universal basic income through the back door. Before the pandemic, we were discussing, should everyone just get a paycheck that's enough to live off? Well, that's pretty much what seems to have happened as a result of coronavirus. And the question is, will that continue? Modern monetary theory is another example. That's basically been instituted through the back door again, in anything but name, everything but name. So there's a whole bunch of stuff now happening that won't be rolled back, and that's going to have consequences. And I think the biggest investment implication of this is that the old investing rules won't apply in the same way, because the old accountability mechanisms won't apply in the same way. So if you invest in a bad company, normally that company goes bust or performs badly on the stock market and you lose money. Well, right now it seems to me that the worse you do, the more likely you are to get government support. So it's sort of an upside down, strange world. It's a bit like 2008 was for the banks, but for the entire economy now, where everything is backed, and bad news is good news, not just for the banking and financial system, but everything else.
And it's almost like the people that they are willing to just let go off and go bankrupt. It's not so much companies now; it's people. I mean, like there seems to be a whole cancelling of the people that are proponents of the free market and all those kinds of things, wouldn't you say?
Yeah, I agree. It's a total nightmare for a lot of our readers and a lot of our customers. They're often small business owners or professionals on a small scale, so they fall through the cracks. And I've often fallen through government cracks on bureaucratic issues. I currently am in Japan because the pandemic's made a mess of all the visa systems, obviously. So I get really frustrated about these issues, but it's not my business that's on the line. So I can't imagine how it is for a lot of the readers and subscribers of our newsletters who've got these small businesses, and they have been hammered worse than anyone by the not just the pandemic, but the lockdown and the restrictions and the government policies. And they don't get the support that surely legally they should be entitled to if the government's the one that's causing the problem to their business and to their income in the first place.
At what point does a reckoning come, though? Because you mentioned China, and obviously the relationship between the US and China is likely to be very different now. Obviously, Trump's different from Biden, but and I'm just being devil's advocate here. Like in China, you've got a very autocratic government running the country, as we all know. But they've kind of, been allocating the GDP for decades. And it seems to be, on the face of it, what would you say to someone that says, well, it seems to be working there? I mean, I think the state-owned enterprises, the profit motive doesn't exist. It's just about keeping people employed, isn't it?
Yeah, so the best way to explain that little mystery is to say that it's not so much about whether you've got a centrally planned economy or not, or communist or capitalist. The question is what the direction of change is. So China, at least was extremely communist, extremely centrally planned, but it's been becoming less so gradually over time, at some points rapidly. And that change in structure of the economy allows the change in the size of the economy, the economic growth. So at the moment, one of the issues is whether China is actually going back towards central planning. And as a result of that, will their growth slow down or even stop? Whereas America was very capitalist, was very free market, but has been gradually becoming less so over time. And so its growth rates have been falling over time. So it's the first derivative. It's the direction of change of the government and the economic system, not the government and the economic system itself, that you should compare to the growth rates. That said, obviously the US is still more capitalist than China. That's why its economy is larger and wealthier and So I think it does make sense if you look at it from that angle. The question is really what happens next, right? That's the one that we should always be worrying about as investors. And I think the coronavirus situation has empowered central planners globally. And that means whatever the course of all of the different economies was before, it's now going to be less good. And also it's important to consider, not just it's going to be less good for everyone, but who's hit worse than others. And that's why that distinction between the countries that have had coronavirus and the ones that haven't is important, because you'd expect those that have gone through the crisis, or at least are further through it, would outperform in the future, at least economically.
You said in part 2 of your beefy chapter of the book, you're talking about an X-rated recovery. Now, the concept of a V, everyone knows what a V-shaped recovery means. We had one of those in March 2020. It looked like this was it. This was finally the stress in the market and the economy had reached the point, and the coronavirus just tipped it over the edge. But it was a V shape. It came right back. The other one we know is the W shape. You said it goes up, it goes down, it goes up, it goes down, and the other one is, I guess, Vern Gowdy would be a predictor of this one, the L shaped, where it's like Japan from 1989. It just hasn't recovered at all. But you say you make the case for an X-shaped recovery. Do you want to explain that concept?
Yeah, for investors, I think the broader economic situation is less important to what's going on within the economy. And I think the X-shaped or X-rated recovery is the way of explaining that, where some things are going to be in permanent trouble as a result of the coronavirus pandemic. So those things will be going down over time, and that's the downward stroke of the X. But some things actually do well as a result of the pandemic. We've seen that happen with the tech stocks. And that is the upward slope of the X-shaped recovery, because the two make an X. And I think investors, instead of focusing on L's, V's, and W's, should be focusing on what within the investment markets and the economy will perform well, and what within those markets will perform badly, so that they can identify and separate out the two. And that is where the investment trend comes from, the investment implication. But I'd like to go back to, because I didn't quite answer the second part of your question, where you said, well, where is the reckoning going to come from? And I think that's the biggest question for all of this, because at what point does it stop? And part of the answer is, I don't expect it to stop as a result of the pandemic ending. That's the issue we just spoke about. But I think, historically speaking, these things tend to end by having exhausted the policies that are being used to try and prop things up. So in the current situation, that is most likely to be a combination of deflation and inflation, because what's being used at the moment as the policy lever to rescue everyone and everything is money printing and government deficits. So it seems like nothing can fail, at least nothing large, because we can print money and we can borrow infinite amounts of money using the political system to rescue everyone and paper over all problems. That's why the stock market's going up, despite the fact that the economy is in more of a W-shaped recovery. So you've got this divergence between asset prices in the stock market and what's going on in the real economy. And that is usually the first signal of this inflation and deflation issue becoming a problem, because you've got money flooding in to the global economy from government money printing and government deficits. The question is, where does that money go to? Well, it goes to the places that are going to do the best in the X-shaped recovery. So the money is flooding into those tech stocks and the parts of the economy that are benefiting from the virus. Then it tends to filter down eventually to become inflation, but that takes time. Historically, we haven't had that combination of ridiculously large government deficits, plus at the same time, ridiculously large amounts of money printing. And now that we've got those two, that sets the scene for inflation. But the first part of inflation is this asset price boom that we're seeing, including in property prices around the world, where people can borrow money for ridiculously low interest rates. And that is pushing those house prices up. The economists who sort of pioneered the way of thinking about this that I'm using called it a crack up boom, because it's just it's like a fake artificial boom in investment markets, but the economy's getting diverging from it. And the 20s, the roaring 20s, are an example of it. And we all know what came after the 20s.
Are you expecting a similar thing?
Yeah, the question
after
is,
these 20s are over.
well, the question is how long they last and how ridiculous things get during the
That, and
war.
they can always get more ridiculous than you ever expect, or even
That's right.
can
So
imagine.
that's why I mentioned earlier that a lot of the normal investing rules that would have served you well will sort of be not disproven, but they'll be temporarily not working very well, because what's actually going on in financial markets is this absurdity of inflation and absurd levels of deficits and money printing that shift things in strange ways that you can figure out and identify. And the leading explanation of how that works is actually someone called Richard Cantillon, who he saw it happen and play out in front of him during the Mississippi bubble when Jordan Law was printing money for the French king. I think it's the 18th century off the top of my head. So he made huge profits from that bubble because he understood how money printing and government deficits actually make asset prices boom first, and then you get these inflationary consequences afterwards.
So should people be very wary about what they invest in, or is that a stupid question? I mean, or does it not even matter for the next few years because everything's going to go up anyway?
Yeah, so I think you've given the two extremes, right? Because it's like you need to be really, really wary about your investing, but it doesn't matter. So why be wary? So the way that I think you can combine those two is to say that you need to be wary about how you think you should invest. So the old rules of value investing, things like that, are going to be difficult to use in this new environment. So the old ways of investing that you were told were very sound, they aren't going to apply as much in a world where what's really going on is the value of money is falling. So it's a bit like the analogy I often use is, imagine if the number of millimeters in a centimeter changed every few months or years. Well, that's sort of what's going on, is the way we measure things is changing. Is the value of money is just being crushed by printing huge amounts. But that affects different things differently. So if you're trying to build a house, it has a huge impact. But a lot of things, it doesn't really matter that much. And so over time, the effects will make their way through the economy. And one of the first steps of this is asset prices booming exactly the way they are currently. The next phase is sort of a malinvestment phase, where people make investments, by which I mean businesses expand, buy things and buy assets that don't make sense and will be exposed to not make sense at some point. And that's when that reckoning comes in the future. But usually governments lose control of this process, and the inflation does become stagflation, like in the 70s, or hyperinflation.
Would you say they haven't fully lost control yet?
They've lost control.
Like they can't do what Reagan did, for example, in the early 80s, and just ramp up inflation, ramp up interest rates, right? Unless they want to be voted out like next week.
Yeah, this is one of the interesting issues right now, is that they've lost control in the sense of the old framework won't work. Yeah, we've got way too much debt for interest rates to go up. We've got lots of countries this time in the current global economy that would be happy to leave the US dollar as the global reserve currency. Whereas when Paul Volcker was raising interest rates to 15% or whatever it was, to try and save the economy from the same sorts of problems that we're talking about now, there was no real challenger. Whereas these days, I think China and Russia and a lot of other countries, especially the oil exporters, would not put up with raising interest rates significantly because they need US dollars as part of the global trade system. So the Americans are starting to lose control over the global financial system. And that adds a whole new level of risk to what happens next. One of the possible outcomes of this is actually a return to the gold standard, believe it or not, which is a totally bizarre idea, at least it's a totally bizarre sounding idea to most people, but it's actually historically what tends to happen in these situations when the global reserve currency issuing country, in this case the US, starts to lose control over its own currency and its own level of debt. And as a result of that, all the other countries say, well, using the US dollar no longer really works. And these guys are printing it like mad, which is deeply unfair because it means they can buy global imports just by printing money, whereas the rest of us have to earn US dollars first. This is what happened with de Gaulle and the French gold before the 70s. And this time, countries won't put up with that, China, Russia, and so on. And so they will challenge it. And the obvious place to go, historically speaking, when there's no obvious up-and-coming new global power, is to go back to gold and the gold standard. I think that's just one of the reasons we invest and recommend investing in gold at Strategic Intelligence.
Well, there is a new upcomer currently, isn't there? The Bitcoin. I don't know what your thoughts are on that, but it's going to be, it adds a fascinating dimension to the whole power play, doesn't it?
Yeah, the interesting thing about Bitcoin is not so much the price going bananas. I think it's the idea that the purpose of Bitcoin was to have a financial system that's not a financial system. So you don't rely on governments. In fact, governments can't interfere. You don't rely on banks. In fact, banks can't interfere. You just rely on the blockchain and the rules of the system. That was the promise of Bitcoin. So the question is whether now Bitcoin is booming because I suppose the crack up boom is on, money printing is happening and people are losing faith in that system. Therefore, they're looking for an alternative, and Bitcoin is potentially a decent alternative to that. Or whether Bitcoin is like really going to be part of some sort of global solution. There's two ways that this sort of currency reset can unfold. You can have global governments either get together or have a big argument over the US dollar being the reserve currency and going back to gold. Or you can have average everyday people all around the world saying this current system of the US dollar is ridiculous. What are we going to do?
People voting with their wallets and their feet, right?
Exactly. And that can make the change happen too. I think Bitcoin is viable as a viable alternative for that bottom-up style approach of people voting with their feet. Businesses are starting to take an interest in that. People are getting paid in Bitcoin for employees as well. So that the fact that the price is rising, I'm worried whether it's just a speculative mania or whether it's actually telling us something valuable. But given what Bitcoin at least pretends to be or claims to be, it is a good example of what you would expect to happen given what money printing does. You would expect things like Bitcoin to be booming in the way that it is.
It's kind of that whole decentralization thing that, you know, that people tend to go towards in the face of these crack ups. Part of your thesis in the chapter is that you think the traditional banks are in a long-term decline. Do you think that's part of it? I mean, so for example, in Australia, you wouldn't suggest, or at least you would lighten up on your holdings of, say, the Big Four or something like that, would you? Or do you think this is a global phenomenon that?
Yeah,
sorry, I thought you were going to say something.
It's already played out in Japan to a huge extent, where the banks never fully recovered from the bubble and the low interest rates. Is pretty much played out in Europe, where I think the bank stock index for European banks is at all-time lows since the index has been created, I think in the early 90s. So the banks in lots of different places where the sorts of changes that are coming to Australia have played out have massively struggled. Australia was supposed to be an exception to that, largely because of immigration, something that COVID has struck down. Yeah. So my worry is that the banks are going to be one of the main parts of the market to struggle, and fintech is really coming for the banks, providing alternatives. I was talking to the CEO of a company called GlintPay, which uses a MasterCard, but instead of having your account in a particular currency, it's actually got grams of gold. Now, as you spend, the grams of gold go down that's in the account. But the point is that you're not exposed to these alternative currencies and the fiat currencies, the alternative fiat currencies. But the point being that at some point you can just transact with gold to other people. So you can avoid the currency altogether. So there's all these little innovations that are popping up like that. And I think the best way to understand this, that makes it really simple for people sitting at home who don't want to spend time on understanding fintech, let alone the current SWIFT payment system or the US dollar as a reserve currency, is just to think about what Uber did to the taxi system or what Airbnb did to the hotels. Well, what if fintech does the same thing to the banking system? What if suddenly there's a viable alternative that isn't stuck with the same ridiculous rules and fees and delays and all the nonsense you get with banks? What if you had something that works instead, that is separate to all that? That'd be quite powerful and useful. Now, we're not there yet. That's worth emphasizing. I don't think Bitcoin or any of these other fintech companies can compete yet. I suppose there's some exceptions. I use the foreign exchange fintech alternatives. So there's reason to believe that they will develop over time and start to compete. I wonder whether the banks will actually manage to sort themselves out as a result of this, as a result of competition. But the point is that I don't think it's going to be the same sort of boom industry and as good an investment as it has been over the last 20 years. The banks have been really good over the last 20 years.
They're kind of entrenched in the whole current system anyway, aren't they? I mean,
that's right. I think they won't be able to escape. Probably the biggest argument is simply that low interest rates are bad for banks, and we're going to be stuck with low interest rates for quite some time.
Just a couple more questions, and I've kept you on, but I've just more questions keep coming into my head as we talk, because I love talking about this stuff. But one of the key solutions in that you mentioned a couple of recommendations, which I won't go into here because they're people should read it for themselves. But we talked about gold and how important that is, and it's what people tend to go to when they start when distrust becomes too much in the current system. And you mentioned that, in fact, Australians specifically have an advantage in the gold market because of something that you call the Gold Quadrants. Do you just want to explain that concept a little bit? I think it has something to do with the exchange rates as well, doesn't it? So,
yeah, the challenge and the reason this is so important and relevant is that a lot of the people who write about why gold is a good investment tend to be American, and the price of gold is measured in US dollars. So what they'll say is there's all this money printing going on. Therefore, the US dollar is going to go down, which means you should own gold, because then gold goes up. Well, there's a problem for Australians then, because the Australian dollar gold price is the US dollar gold price converted at the exchange rate to Australian dollars, which means there's two important variables. It's not just about the gold price. It's just as much about the exchange rate. So if the dollar is going down, and that's the key prediction of these people who are recommending gold in the US, well, that doesn't necessarily mean that the Aussie dollar gold price is going to go up. It could just mean that the Aussie dollar goes up instead, leaving Aussie gold investors going nowhere. However, what tends to happen, and this is the point of the Gold Quadrants, is that the Aussie dollar tends to move in a way that is beneficial for Australian gold investors, because the Aussie dollar is a risk currency, which means that when there's some sort of crisis and the US dollar having a plunge in value, and the economic consequences of that, when there is that sort of crisis, the Aussie dollar tends to drop, which means not only is the gold price going up in US dollars, it's going up even more in Australian dollars. And that is the scenario that is likely to play out in a crisis. Now, the whole point of investing in gold is that it performs well during a crisis. That is why people should hold some of it, not as their entire portfolio, but they should have some gold. So the point is that when you want your gold to perform well, when you are hoping that it does well while everything else is doing badly, it will not just do well, it will do even better, because you're an Australian gold investor rather than an American one. The scenario under which the Aussie dollar gold price does especially badly is especially unlikely to happen, and we tend to usually be in this awkward in between of the gold price going up but the Aussie dollar also going up, which means there's no clear result, or the converse where they both go down, which means there's no clear result. So the gold price usually sort of trends along sideways, but when it does go up during crisis, it goes up faster than for the Americans. So that's why I say Aussie investors are in a better place to invest in gold than just about anyone else, thanks to the nature of our currency.
Yeah, right. Well, people get to discover all about that when the report comes out, which is very soon, I believe. Just one question out of interest, really. When will people realize, governments especially, that printing money you're almost destined to fail, and yet they do it again and again? And you've seen it in it's pretty much what caused the Roman Empire to collapse, the Ottoman Empire to collapse, the British Empire to collapse. But why do we keep making the same mistakes again and again? And or is that such a big question to end on that?
Yeah, I think the quote, I think it's from Milton Friedman, who we also quoted earlier, is that governments never learn, only people learn. I think a friend of mine actually gave me a framed picture of Milton Friedman with that quote underneath it that I've got somewhere at home in Australia. But one way to look at it, that the whole story that you've just outlined, is that monetary history goes in cycles, and it's going round and round and round. The same things keep happening in the same order over and over again. And we're just in another one of those phases of this cycle. Perhaps you could say it's the last part of the phase, because it's where things start to fall apart. But this isn't unusual, and that means that investors can take lessons from history and look back at what happened during those times in the past. As we suggested, it tends to be a return to the gold standard in some form,
or some form of sound money. It has to, because yeah.
The irony of what happened with Paul Volcker raising interest rates is that if he hadn't been as brave as he was to do that, and I think there were effigies being burned of him, if he hadn't been brave enough to bring down inflation, the severe inflation that we had all around the world, and his actions controlled inflation globally because the US dollar was the global reserve currency. If he hadn't have raised interest rates that much to bring down that inflation and incurred all of that bad response, negative feedback to what he did, then there's a good chance we'd be on the gold standard now, because the whole thing would have gotten out of control in the 70s instead of getting out of control now. So there's a bit of irony in how that played out. And it's remarkable how close the US got to going back to the gold standard back then.
But you get a bit of, you do get a bit of a sense back then, the entire world was seeing the death throes of socialism in a way. I know the Soviet, the USSR was still going strong at that point. But, especially in the UK, you had, you just come out the winter of discontent. The socialist policies of Europe were decimating economies. Inflation was rampant, but there was no economic growth. And there was wage inflation too. And a big swelling of governments all over the world. So you kind of had that. People knew that kind of thing wasn't working, and then you had an impetus of almost going back to a free market system, or at least a more free market system. Nowadays, you get the sense that, I don't know if it's just of my own reading, but I get the sense that people are deeply skeptical of capitalism itself. And it's this, I don't know whether it's, you got a new generation coming through, and all these uni graduates that have done brilliant degrees in they're not the sciences, put it that way, and lots of English grads, and they've just been fed this ideology, really, that governments need to control things, and so it feels like the impetus is different this time, and it's a bit worrying. I think it's a bit worrying anyway.
I'm not sure the impetus is different, because I think that's just what students have been like for a very long time.
Maybe you're right.
What's different, though, that I'm really worried about is that what's the response going to be from I don't know, the adults in the room now? Is it going to be, well, we can't print money, well we're doing it, we've got to worry about deficits? No, you can't say that given what's going on. We've got to worry about civil liberties. Who cares about civil liberties right now? So the point is that the counter argument to what those younger people, they tend to be young people, are saying is just completely lost. It's been lost to coronavirus. So now I don't understand how the consequences, how the counter arguments can be made. And I do understand the consequences of exactly what you've been saying. Is this more of a turn towards socialism and the consequences of socialism? And I think I read a tweet from someone along the lines of, my husband grew up in East Germany, and all this coronavirus stuff just reminds him exactly of how everyday life was in East Germany. So the point being that we're not going towards socialism or communism, but we can have a lot of economic effects, the economic consequences of it. And it's going to be a weird situation for capital markets and financial markets to be fairly free market. People do invest in stocks. And yet the broader economic system is becoming very centrally planned. That's going to be a weird situation. I don't think it's happened before. My other worry is that basically financial markets, especially the stock markets, become a retirement machine. Politicians have decided that financial markets are good. They just go up in the long run. And therefore we should base the retirement system on those financial assets. And if you plug in lots of money, you'll get more money spitting out the other end, and that will lead to a wonderful retirement. Well, that's not what financial markets do. That's not what they are. And they have crises and they break down. So betting people's retirement on that system working is very dangerous. And Australia's done this more than anyone. So
the trillions in super.
This adds the need for governments to do something in that space as well. So financial markets are going to be especially strongly manipulated by governments and central banks in the next few years. And so the weird little effects that we've been talking about, calling it socialism and central planning, they're going to be playing out in financial markets more than in other places, which is an extreme statement considering a lot of people in the world can't go outside. But I think in financial markets is going to be where a lot of the impact is going to be felt from all the nonsense that's going on at central banks and governments around the world.
Well, it's going to be a fascinating thing to watch, and at least it will keep us busy having to write about and disseminate it for our readers and subscribers. Cheers, Nick. Yep.
It's strange to think that we've been involved in this sort of ideas and writing about these ideas and trying to help people since the financial crisis got really bad, and then the lead up to it. So we don't really know what the world was like before, 2008 crisis, European sovereign debt crisis, 2018 had a crash, commodities have been going down, interest have been going down. So if there is a real big shift in the way things continue in the future, such as inflation breaking out, then it's going to be such a radical change for us to think about and deal with. Whereas some of our subscribers were around for some of the things we were discussing, the winter of discontent, those ridiculously high interest rates and high inflation rates. So I wonder if some of our readers can help us and tell us what they did and what worked for them and their families and their parents back during those times.
Yeah, I remember my dad, he always tells a brilliant story about how there was one period in his life where they got a mortgage on the house that they still live in now, but it was back in the 80s, and it wasn't the winter. It was 10 years after the winter of discontent, but it was when the UK were thrown out of the exchange rate mechanism. Interest rates went up to 17% in a day. And Dad said he was in the back of a taxi, he heard it on the radio, he was already mortgaged up to his eyeballs, and he'd already, to stop the chain breaking down, he guaranteed the mortgage of the people buying his previous house. So he had 2 loans just for a 2-month period, but he just flung his arms back and just started laughing about it. He's like, well, what do I do now? But I don't think that lasted very long, but there's some weird things are going to happen. It's going to be fascinating to watch. Just as a brief thing to finish on, Nick, what do you propose people do? And I know you detail it all in your bonus chapter, but what's a key takeaway that people can take away from this conversation?
I think people need to shift their thinking about what constitutes a good and a bad investment. They need to think about some new things that they probably didn't think about before. The big one being counterparty risk. So what is the chance that your bank goes bust? What is the chance that your broker has problems? What is the chance of extremely high rates of inflation or ridiculously high interest rates? And can you withstand, and can the companies that you deal with for your financial day-to-day activities, can they withstand a shock like that? That's counterparty risk. What's the risk of the people you rely on having a problem? You need to be robust yourself to these extreme shocks. So part of that would be holding gold, for example. And I think people need to become speculators. I don't think people should be investors in the same way that I would have said they should be for the period before the financial crisis. I think the quality of an investment story, unless it's a high risk, high return one, is going to be less important in a world where a government decides who gets bailed out and who doesn't. I think it's going to be a question of who benefits from that sort of environment. How can I speculate to profit from that myself? There's some famous examples in the book, Jim Rickards' book, about speculators getting extremely wealthy. The Kennedys, and there was a famous German industrialist who realized what was going to happen. So he borrowed huge amounts of money, and then the value of that money completely crashed. And so his debts were worthless and easy to repay given what he'd bought. So I don't recommend going to huge amounts of debt, but they're good examples of how becoming a speculator instead of an investor is probably going to be a good idea over the next few years. The exception, which is worth mentioning, is extremely innovative new technological ideas that have an investment case where they will boom regardless of what's going on in the broader economy, or regardless of the problems that we've been talking about.
Well, it's been fascinating talking to you, Nick, as always. We'll catch up again very soon, and we'll let people know when finally Jim's new book is out, and alongside with it your really extensive and interesting bonus chapter. So cheers, mate.
Thanks, Woody.
Have you warmed up a little bit? I hope so.
You can see the sun creeping in the corner here, right?
Yeah, there you go. All right, take care, buddy. Cheers.